Hello. In this video, we'll consider steps 4, 5, and 6 of the corporate formation and contribution checklist. Now remember that whenever a transferor shareholder receives stock in exchange for property transferred to the corporation, it's possible that the transferor can receive non-recognition treatment. Recall that in step 1, we considered whether the transferor qualifies for Section 351 non-recognition treatment. In steps 2 and 3, we considered the adjusted basis of the stock received as well as the holding period. In steps 4, 5, and 6, we're specifically focusing on the transferee corporation that's receiving the property. Step 4 deals with the gain or loss recognized by the transferee corporation. The corporation transferee never recognizes gain or loss. Never recognizes gain or loss. Now this applies whether the transferor qualifies for Section 351 when we considered step 1 or not. This also applies to a transferee corporation when formation occurs or any contribution. Step 5 deals with the adjusted basis of the property received by the transferee corporation. The general rule is that we carry over the basis of the transferor and we add any gain. That's all we do. We simply carry over the adjusted basis of the transferor. So whatever basis the transferor had, we carry that over and we add any gain. Now recall that in step 2 of our checklist, the transferor's adjusted basis and the stock received, we had a long formula. We started by carrying over the adjusted basis, subtracted away any cash received, subtracted away any liability relief, which we call constructive cash. We subtracted away any property received, any fair market value of property received, and we added gain. We don't have to go through all that. All it is just these two items. Now there's a special rule. We have to consider this special rule. The special rule says that whenever a transferor transfers property and the fair market value of the property is less than the adjusted basis, for this rule, we're not going to carry over the adjusted basis. We're going to simply use the fair market value. The idea here is that there was anti-abuse. Now the corporate provision in the Internal Revenue Code is in subchapter C. There's lots of anti-abuse rules out there. What happens is taxpayers try to basically push the envelope with respect to transactions. They find creative ways to take advantage of a rule. So if you will, these are ways to kind of stop special treatment that have occurred that Congress has to put a stop to. Now with respect to this rule, we have to add up all assets adjusted basis, and we compare the fair market value. So let's say that A transfers property that qualifies in a Section 351 transaction, 351A under Step 1. Let's say that the property, and we're only going to consider Step 5 with respect to this transaction, A contributes 2 pieces of property. Building 1 and 2. Let's say the adjusted basis of building 1 is 5 and building 2 is 4. Let's say the fair market value of building 1 is 3 and the fair market value of building 2 is 5. If we add these up, you'll notice that the adjusted basis total is 9 and the fair market value is 8. Now if you look respective to building 1, you'll notice that there is a $2 loss. What do I mean? $2 inherent loss. At the time of the transfer, the adjusted basis was 5, the fair market value was 3, it's a $2 loss. However, building 2 has a $1 inherent gain. The fair market value is 5, the adjusted basis is 4. When you look at the excess, which is exactly what this rule is, we have a $1 inherent loss with respect to both items. That $1 adjustment actually gets reflected to the adjusted basis of building 1. So what happens is instead of taking the fair market value of 3 for building 1 under the rule, we actually take an adjusted basis equal to 4. How did I get that? It's the 3 fair market value plus the 1 adjustment from the total. So that gives us 4. So you look in the total. Finally, in step 6, we consider the holding period of all property received by the transferee corporation from the transferors. Now, it's important to note that all property tax. Tacking, consider step 3. Tacking means that you get to add on however long the previous owner, which is the shareholder, held on to this. This concludes the 6-step approach with respect to corporate formation and contribution checklists.